or supply areas. So traders have the opportunity to sell in 4 different supply zones. Some are shorting the first zone, some second, the third, and the last one, which is the highest up and often the safest zone to trade. It's the extreme supply or demand. But seller-biased traders do not take into consideration that the trend has shifted and changed right here after price has managed to break the previous high. So the first traders that tricked by smart money are the ones that short this supply zone. Where would these sellers place their stop losses? Often right above the supply zone, and their take profit often seen below the major lows. So what the market does is giving them confidence by slightly going into their direction and then stopping them out by breaking the supply. The mistake these traders have done is trading based on the previous market trend, when all they had to do is to watch the trend that is being played in the present. Opposite of the supply zones, in an uptrend price forms demand zones where price reacts and ends a pullback by pushing the price to break the highs. The same thing happened to the traders that sold at the next supply zone, while the smart money knew the demand zone was formed in an uptrend, so price should respect the demand instead of the supply. Knowing this leaves smart money with profits that other traders have probably lost because they didn't trade based on the current trend. And the same process basically repeats over and over until does a trend change and supply zones will get respected instead. The next type of liquidity is the highs and lows trendline liquidity. This is very simple and straightforward. In uptrends, this is usually met by price leaving a demand zone. The market slowly goes up, creating a trendline channel. In the uptrend scenario, it is an ascending trend line in which buyers open their orders at the touch of the bottom of the trend line, and sellers open their orders at the top of the trend line channel. What often happens is a sharp move to fill the demand zone to the downside. This move takes the liquidity of the buyers by stopping them out. The smart money way is to wait for the traders to get liquidated, and we enter a buying position on the demand zone like we did on the previous examples. Now the trend line can also be a descending trend line, and it works the same way, with liquidity sighting above and below the trend line. Smart money waiting for the demand zone to be filled. A quick example for the descending trendline liquidity. A demand zone in the left from which price shoots up, confirming the uptrend. The pullback, which forms a descending trend line with resting liquidity above and below the trend line. Price comes back to fill the demand zone, which stops out the buyers by breaking down the trend line. After demand fills, the smart money traders start opening buying orders that pushes the price up. Traders that still shorted the top of the trend line get stopped out. Then the uptrend continues and forms new demand zones that can be used. But be careful, because if the trend reverses into a downtrend, these demand zones will no longer be valid. The next liquidity concept is the liquidity grab. A liquidity grab is a stop hunt, sweep, liquidation. You might have heard these before. Essentially, they are all the same, and it indicates an intentional price manipulation to trap retail traders. A liquidity grab is a deviation or a break of the liquidity types we have presented previously. Usually after a liquidity grab takes liquidity by rejecting price action structures, and then it takes the market into the opposite side. A liquidity grab should be met hands in hands with a high volume or increasing momentum, so the price should react aggressively because it has taken liquidity. Therefore, a lot of orders have been opened and closed in a short time span, so that creates large candles or long wicks. We have already shown liquidity grabs on the charts in the previous examples. We have covered the theory on this one. And the last liquidity types is the daily session liquidity. The most important trading sessions are the New York session open, which has the largest volume on USD pairs. Then the London session and the Asian session. You will likely see how, for example, how London sessions takes the Asia session high, and then New York session takes the London session low, and all kind of sorts similar manipulation tactics. If you want to know when the sessions start, you can type on TradingView's indicator tab the indicator called Sessions, and it will display each session based on your time zone. And once we put it all together, we should be able to know to read and spot liquidity in the chart. This is the gold market in the 4-hour time frame. On the left side, the gold market started an uptrend, so an uptrend creates demand zones. This one, then this one, which fills and price breaks up the high, creating another demand zone. An ascending trend line is formed, so there is an increasing number of buy orders opened each time the price hits the ascending trend line. Where to, they place their stop loss below it, and as seen after they take the buyers out of their positions, just for the next candle to break to the upside, It's simple. A liquidity structure is formed, wait for price to liquidate that structure full of traders' stop losses, and then look for a trade opportunity. Here the price starts a significant downside movement, which means smart money are closing their buy orders and opening sell orders. This significant move breaking the previous major low, so we got a first indication of a trend reversal. Price pulls back, and again it leaves an ascending trend line with stop losses below it that they are taken very quickly. Then the demand zone fills out. The trend has changed, so this demand zone is no longer valid, even if price bounced up after touching the area. We have market what probably could happen next, for price to fill the supply zone and push it down to the second demand area. This move liquidates